In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Amazon everywhere, in your microwave, your car, your wall clock, and beyond. How Amazon plans to take over your home. Plus, Gap's journey from a single store and brand to a global business. The outfitter is introducing its sixth brand as an online exclusive. We will speak exclusively to CEO Art Peck about his strategy for Gap's comeback. And online ticketing and meeting platform Eventbrite stock surged after it listed and raised $230 million. We'll speak to the company's co-founder and CEO, Julia Hartz. First to our top story, Amazon has held another of its surprise product launches in what's becoming an annual affair. The e-commerce giant has revealed a slew of new Echo devices designed to integrate its Alexa AI further into our lives, including a new microwave, a clock, and Alexa for your car. Amazon Senior Vice President of Devices and Services, Dave Limp, joins us now from Amazon headquarters in Seattle. Dave, thanks so much for joining us. A lot of products here. Which one of these do you believe is the most important and why?
I think a lot of the products today were super important, but if I had to pick a couple, I would say that the new Echo Dot, which I have one right here, was a great product for us. It's been the best-selling speaker ever, and now we've improved it across a lot of different dimensions, and we think customers are going to love the new form factor and better sound. And then also the new Echo Show. It's got a bigger screen, a brighter display, and it continues on our path to have Alexa show you things, and I'd be remiss without talking about Alexa Auto. It's Echo Auto. It's a new product for us that brings Alexa into your car.
We have to talk about the microwave, perhaps the most unexpected product you unveiled today. How does it work, and why do you think this is a good opportunity for Amazon?
The Amazon Basics microwave was about building a reference design to show that you can connect just about anything to the internet and make it smarter. You know, I mentioned earlier today that, you know, the interface on your microwave's kind of been stuck in the late 70s for a long time, and we think with Alexa we can make it more convenient and super easy to cook. And in addition to that, you know, we've added Dash replenishment service, so if you run low on popcorn, the microwave will automatically reorder you some more. It's super fun.
Now, there are so many products. Are you concerned at all that customers will get confused or overwhelmed?
I don't think so. You know, one of the things we've always strived for at Amazon is giving customers a lot of choice. You know, and when we offer more selection, customers are really good about identifying what they want to buy, what they want to use. And then we add on top of that the reviewer system at Amazon that lets customers add reviews to products and tell people what they like about them. And that allows people to help them choose. So we think the breadth of products is really a benefit for customers.
Now, you unveiled a new speaker accessory to make sound richer, Sonos down on that. You know, what do you think the potential is in the high-end speaker market where you do have entrenched competitors?
Well, first of all, I'd consider Sonos a great partner. I'm a big customer of Sonos products. I love them. And, you know, Sonos customers are passionate about really, really great sound around their house and the convenience that they offer. And now Sonos has a line of products, including Beam, that integrate Alexa into them. And we want customers to have Alexa everywhere. Our products are more breadth in terms of mainstream products, but we know that the level of sound that customers are expecting is going to continue to improve over time. We need to improve on behalf of customers, and certainly Sonos does as well, and I know they will.
You also played up your partnership with Spotify when you have your own music service, Amazon Music. I mean, you know, do you have concerns about cannibalizing your own product lines?
We really don't think about it that way. You know, what we think about is we want to give choice to customers. And the nice thing about Alexa is that the service is open to developers of all types. So Spotify's been a great partner of ours, and there's millions of Spotify's customers on Echo and Alexa, and it's still growing. And we think that that's great if customers want to go that way. We're also super proud of Amazon Music, but there's not going to be just one winner in music. It's not the headline that there's going to be one music service chance to win it all is not likely. There's going to be multiple winners, and I'm sure Spotify and Amazon Music are going to be on that list.
And what about when it comes to the smart speaker business in general? Obviously, Amazon had first mover advantage there, but Google Home is rapidly encroaching on your territory. Do you think this is a space where there are multiple different competitors, or will there be one competitor, Amazon or Google or someone else, that takes the greatest share?
We really don't think about it in that aspect. We don't focus a lot at Amazon on competition, but instead take a step back and say, what do customers want? And if we focus on all the inputs, like making great products, great services, a great developer platform, then customers will come. And the fact that we sell X or Y or have X market segment share or Y market segment share, that's an output of what we're working hard on inputs. So far, we're super excited about what customers have been able to do. There's no question that we think Alexa and Echo is the leading assistant in the home today, but we're going to have to continue to work hard on behalf of customers as we move forward.
The event today was sort of Apple-like, and it seems this is becoming an annual affair. What can we see from, or expect to see from, Amazon's device strategy and how it fits into the broader company going forward?
Well, our strategy's been the same for 12 years now, where we were kind of founded internally, and we started with our first product, which was Kindle. And our job is to build devices that aren't just gadgets that kind of sit in people's drawers, but build devices that customers want to use in integration with services that are out in the cloud. Echo and Alexa is an example of that. Kindle and the Kindle bookstore is an example of that. And we're going to continue to look for new opportunities of different types of devices and services that will delight customers. I'm not going to announce anything on the roadmap besides the 70 products and services we announced today, but we're continuing to work hard, and we're excited about what we can deliver to customers.
All right, thanks for counting them for us. 70 products. Amazon's Dave Limp from Seattle. Appreciate you joining us. Coming up, Gap introduces its 6th brand, how the retail company is using the men's athleisure line to push even further into e-commerce. That is next. This is Bloomberg. Over the last 46 years, Gap has grown from a single store to a global business. And with 3,300 brick-and-mortar stores in its back pocket, Gap is betting even bigger on the future of e-commerce. This week, the company introduced its 6th brand, Hill City, as an online exclusive. And Gap CEO Art Peck compares the new men's athleisure line to a tech startup.
It's very much of a startup. We starved it for resources, almost like angel funding. But it sits on a platform of all the capabilities that we have as a global apparel company. And so launching it online means that it's going to sit on our platform. It's going to be exposed to hundreds of millions of visitations that we have every year. So it's got the assets of a big corporation, but launched in a very small entrepreneurial way.
I sat down with Peck to talk about Hill City and get an update on its rapidly growing brands like Old Navy and Athleta, as well as his strategy for a full Gap comeback. Take a listen.
We've been fairly forthright in saying the importance of Old Navy in our portfolio today. So if you look at size and profitability, it has already surpassed Gap brand. Gap brand is, and we know this because we've done the research, not just because I want to believe it, it is still very relevant to our consumers. But it's 50 years old, and brands morph and brands evolve. And we're doing work right now to really position Gap brand back to its core. But you know, I love every brand in our portfolio. We've been very forthright with the investment community in saying that we're going to be responsible managers of the portfolio. And our job at the end of the day is to do many things, not the least of which is create value for our shareholders.
What about Banana Republic? You know, you're in the middle of a turnaround there. It is looking up. What are you doing differently, and what is working?
So what we're doing differently is what we've done when Banana was at its best, quite honestly. We had a moment where we went into a bit of a tortured fashion phase, especially for the women's product. And Banana at its core, and this is a Banana, this is from the holiday collection, I pulled it out of the studio, Banana Luxe Flannel with stretch in it, the hand is beautiful. Banana at its core is about neutrals, about amazing fabrics, incredible hand feel, and versatile pieces at a slightly higher price point that are the foundation of his and her wardrobe. It's not a work brand, it's a life brand. And as we've really put product back in our stores, great fabrics, neutrals, on trend but not tortured fashion, we've seen the customer respond to it almost overnight.
So when do you see Banana being back at its best? 2 years, 3 years?
I think best is always something that you're aiming towards, and it's always something that you're going toward. But I expect to see a long run here of Banana continuing to grow and continuing to grow market share. I'm really excited about it. And if you think about it, what Banana is at its best is it is a extraordinarily high quality, well-made, and fairly priced alternative to contemporary brands. And that's really when Banana is really chugging along, that's what it's doing best.
I'm all about Safari Banana. That's my preference, Jesse.
We have a flight suit in the assortment right now. It is very cute. I actually showed it to my nephew's fiance, who was an F-18 pilot in the Navy, and she looked amazing in it. So.
Athleta, another bright spot.
Yep.
How big does Athleta get, and big enough to break out its own metrics like Old Navy, like Banana?
Eventually, we will break it all out, and that's something we talk about because we want people to understand the powerhouse that we have in that brand. I see nothing that will slow the brand down, quite honestly. It continues to be 50-50 stores and online, so it's truly an omni brand. Our customers shop seamlessly across the online business, the catalog, and in our stores. So I'm not going to call an end in sight because there is no end in sight. We really feel like this is a brand that has very significant growth potential in front of us.
Now, part of what you've been struggling through is inventory issues. Is that working out? When will those, in your view, be completely behind you?
Yeah, inventory has been completely in line across the entire company, with the exception that we took some product out of Gap brand, less because we had inventory issues and more because we felt that the product was not on brand. So we took that product out. We've been forthright with the street about it. It's one of the reasons today that the stores feel cleaner and tighter, because there isn't as much breadth of assortment in there. But what we're missing is a little bit of sort of the color and the pop inside the brand. And we said quarter-over-quarter improvement. I'm looking forward to when holiday comes, because that's when, and we have a new president there, that's when you really see his fingerprints on the brand as well.
So what does Next Gen Gap, the parent company, look like to you, and how does it appeal to today's customer? What's that vision?
Of the whole company.
The whole company.
We're going to continue to grow our digital business at an accelerated pace. We've had excellent performance. We're going to continue to grow that business, and that's across the entire portfolio. We're obviously adding a new brand with this announcement with Hill City, and we're looking at other places where we feel that there are white space opportunities for us to participate as well. So I'm not previewing a slew of brands coming, but I do believe that we have an opportunity to add new brands onto the platform, either organically, doing it inside, or through acquisition. And we're continuing to look at what acquisitions might be for us as well. What
does Gap look like in 5 years?
Gap looks like in 5 years, we have additional brands in our portfolio. We have an amazing digital business that maybe at that point it's 50% of the company or 60% of the company. We probably have the same number of stores, but different. And maybe stores that quite aren't as big, and maybe stores that have more technology in them. We have a full suite of digital capabilities that our customer uses for their shopping, buying, and fulfillment experience. And we have an exceptional experience that is truly omni-channel across all of our brands that allows the customer to engage in a high-touch, low-friction way.
Gap CEO Art Peck there. Coming up, more of our exclusive conversation with him and his thoughts on the escalating trade tensions between the U.S. and China, where 22% of Gap products are sourced. Will the cost of your sweaters go up? This is Bloomberg. Alibaba co-founder Jack Ma has said his promise to create 1 million jobs in America is impossible to fulfill because of the U.S.-China trade war. China's richest man made the remarks in an interview in Chinese state-run media, saying the pledge made to President Trump is no longer feasible because of the unstable trade situation. Ma and Trump met in January 2017 to discuss how adding small and medium-sized U.S. businesses to Alibaba's platform would boost employment. There was some skepticism about whether Alibaba could actually deliver on this number of U.S. jobs. But here's how Ma explained to me at the Global Business Forum last year how his pledge would have worked.
So in 5 years, we'll create 1 million jobs. We want enabling more small business in America, helping them to sell products to China, helping them sell products to Asia, which we are pretty good at that. And we think in China, we created 33 million jobs. So each business, if they're online, they can create at least 3 jobs. So we hope that we can help 1 million small business in America. They can list on the Alibaba site, and we help them to sell to Asia and to China.
And Gap is one of the many U.S. businesses feeling the impact of this trade war. Gap, whose brands also include Banana Republic, Old Navy, Athleta, sources 22% of its products from China. With an escalating trade war, CEO Art Peck says raising prices may be the only option. Take a listen.
We're watching it very, very carefully, as you can imagine. This is a trade war, to be specific, that is largely confined to China right now. China has not been our largest country of origin, although it is for many others, for quite some time. We've moved and diversified our sourcing base. Vietnam is our largest country of origin. But some things will be impacted if this continues to go that direction. So we're looking at counter-sourcing in other environments, other countries, and then we're looking and saying, what's the implication here, and what's the consumer going to be willing to pay at the end of the day? And that's the big issue that I think everybody should have as we're moving down this path, which is what this will ultimately be, we think, is a tax on the consumer. And it's unfortunate that this is going to impact consumers, especially as we're getting into the holiday period.
So Apple has said they would raise prices on the watch, AirPods, if they got hit. Would you be raising prices on clothes?
It's something we're looking at right now. And again, it really hasn't impacted it at the moment. But our job, obviously, is to continue to deliver the performance of the company. And I think in some cases, we'll have no choice but to pass the impact of these tariffs through to our consumers.
About 22% of your products are sourced in China.
Correct.
Could you shift that? And are you considering shifting that?
The answer
over
is
the longer term.
The answer is, of course, we're considering shifting it, and we've been doing that for a while. The whole apparel industry has been in a race to the bottom to find the cheapest labor rates. A lot of that ended up in Bangladesh. We modestly source in Bangladesh due to the working conditions there because we require our factories to be certified. But we have been moving with our vendors into other countries where you can get a combination of the productivity and the labor rates. So we see continuing to downtrend China. But there are some items that China is advantaged at, like sweaters and some other things. And so we'll work with our vendors to figure out what we're doing from a footprint standpoint.
That was Gap CEO Art Peck there. Well, the gender pay gap, it's something we've been talking about for a long time with regard to how women are underrepresented and underpaid across industries. But what about the potential wealth gap created by stock options? Turns out for women in Silicon Valley, the pay gap is bad, but the equity gap looks worse. Employee stock grants favor men, and that has big implications in places like Silicon Valley, where big IPOs and paydays mint millionaires and billionaires. And maybe more important, these are the folks that become the influencers and angel investors for the next generation. Bloomberg Business Week's Rebecca Greenfield joins us on the details and what it all means. So, Rebecca, women hold only 47 cents for every dollar of equity that men do. Talk to us about the trends we're seeing in these larger pay packages that are awarded to women.
Yeah, so in one of these first of its kind study, huge amount of data, I think 180,000 employees, almost 6,000 employers. So I think that the stats are pretty solid here, showing that women are only getting 47% of the equity, 47 cents of equity for every dollar that a man's getting. And that, as you said, is just a huge, huge disparity between the two.
Is the equity gap a bigger problem than, the traditional gender pay gap because it can widen so significantly at those high numbers?
Yeah, I think, equity, it's important to note that doesn't always result in a big payday, but it does result in a big payday sometimes, and it makes the next billionaires and the next influencers, and so it's something that I don't think is being talked about or considered. Obviously, the gender pay gap is important, and those weekly paychecks, they add up. But this is something that I think is having an outsized effect that we're not even considering to understand. I mean, this is the first time we're even really having data to show what it is.
Now, you give some specific examples of women in your piece. Walk us through some of those.
Yeah, so we talked to one woman who said she was offered a job, discussed it with a man who was offered the same job at the same time, and he was given more equity. She says that she asked for more equity, and she was told that no, that was standard. She took the job, and then later asked more people she worked with, men, about their equity packages, and they had better ones than her. So she pushed back and then eventually got what she thought she deserved. But I think that's really where we're seeing the problem here. It's that when negotiating pay, it is already a very complicated and opaque process, and equity just adds a whole nother level to that. And if you're not willing to push back and ask, you're not going to get what you want. And then even sometimes for women, when they do push back, they don't get what they want.
Another sub-trend you talk about is mis-leveling. We can presume what that means. How is that playing out?
Yeah, so when startups offer jobs, they're offering a compensation package for a given level, for a given job that you're going to be doing. So the standard, what they say, standard salary and standard equity for that given job. But what I was told happens a lot of the times is that companies will offer you a job for a level that's lower than really the job you're going to do. And this might have to do just with the fact that startups are small and, they don't tend to have HR departments. But if you don't push back and say, no, I'm actually going to be doing a higher level job, then you're going to end up getting shortchanged on your equity and probably compensation too.
Now, we've heard some CEOs like Mark Benioff, CEO of Salesforce, talk about the extensive work they're doing to make sure that pay is not a problem across the organization. But what are companies really doing about this?
Like you said, a lot of companies do pay audits. I am not sure if that includes equity audits. I think that now the conversation needs to shift to include that too, if it doesn't already.
All right, Bloomberg Business Week's Rebecca Greenfield, thank you so much for joining us. Check it out in Business Week. Coming up, ticketing platform Eventbrite had a big debut on the New York Stock Exchange. CEO Julia Hartz tells us how they soared so much on day one. That's next. Plus, the sustainable benefits of vertical farming are undeniable, but what does the new tech mean for farm laborers? We'll take a look at how sustainable tech is changing tomorrow's jobs. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang. Eventbrite, the online ticketing platform, went public on the New York Stock Exchange. The company raised the price range of its shares, then priced on the high end of that, and the stock surged as much as 68%, raising $230 million in its debut. Earlier, we spoke with CEO and co-founder Julia Hartz about the big ticket they punched on Wall Street.
Well, I think what we have been able to outline for investors is that the vast middle market of live experiences is very big and it's still very underserved. So we see about 45% of our new event creators coming onto the platform after not using a technology platform. And so I think that alone really tells us that we've been able to uniquely aggregate many different types of event creators who just before Eventbrite haven't been served with great technology.
That said, it seems like everyone is pushing into this experiences business, whether it's Airbnb or Spotify, or you have a more direct competitor like Splash. How does Eventbrite continue to differentiate itself?
I think Eventbrite has been able to be unique in the market because of our self-service approach. 97% of our event creators are able to sign themselves up and use the service in 2017, and that natural behavior allows us to continue to grow our strength in our business model. And when we focus on really being able to enable event creators and get to the core of the problems that they're trying to solve in growing their businesses, I think we've been able to do that consistently, time in and time out, and that really has grown our strength in the market. We see a lot of competitors in the vast middle market, so we're certainly not devoid of competition, but we also see great opportunities to drive partnerships. So we have a distribution partnership with Spotify as we're helping to enable artists sell tickets to their own shows.
Now, you have done a great job building the platform, but investors always want to know what's next. How do you make sure you're not a one-stop product shop?
Absolutely. So our transactional business is about 95% of our revenue today, and we're really proud of the traction that we've been able to achieve in the market. But that scale and efficiency of the transactional space is not nearly tapped out for us. So when we look at our served addressable market, we see in the upwards of 4 billion paid tickets in terms of addressable opportunity for us. We want to aggregate unprecedented numbers of tickets on our platform because that means the event creators are succeeding, and we succeed when they succeed. Beyond that, we also look at other areas where we can develop the Eventbrite platform to meet the needs of these creators as they're growing their businesses. So pushing further into those problem areas and helping to create solutions is really what we're focused on, in addition to driving the transactional volume.
Now, revenue growth accelerated in the first half of the year, but losses also widened. When do you see losses narrowing, and when do you see profitability?
You know, we reported in our S1 a net loss in 2017. We also reported a positive adjusted EBITDA continuing to strengthen in the first half of 18. And we think that really is the match of this scale. So over 700,000 event creators using the product in 2017, and the efficiency. We'll continue to make inroads towards profitability. You know, we've been great stewards of capital historically, and we think about really reinvesting in the future to drive a positive adjusted EBITDA, but also to see accelerated growth.
In the S1, you talk a lot about expanding internationally, developing new revenue streams to better serve specific countries. Can you give us some examples of where geographically you intend to do that?
Absolutely. So our core countries today and our top 14 global markets still have a lot of room for us to grow. When we look at that served addressable market opportunity, we're only 7% penetrated. So that gets someone like me very excited to continue to push into those growth opportunities, whether it's in the UK or Germany or Latin America or Australia. And beyond there, we look towards areas like Asia as being a potential expansion opportunity for us in the future. But again, in our core global markets, we still have a lot of headway to grow.
And you also talk about how you plan to strategically add category-specific capabilities and develop new revenue streams. What kind of new revenue streams?
Well, when we think about revenue streams, it's really through the lens of helping event creators create new revenue streams within their events. And so every event has a fixed cost component. And so the incremental revenue that we can help event creators produce, whether it be through things like branded marketing or promotion or sponsorships, is high incremental margin for them. And they're really sole proprietors of their own businesses. So every little bit helps.
Now, there are fresh reports about a secret deal Ticketmaster allegedly had with scalpers. Ticketmaster has pushed back on this. You know, what do you think about that kind of behavior, and how do you ensure your own transparent relationship with customers?
When we think about driving trust, it's not just with the event creators who use our enablement platform, it's with consumers. So we see about 50 million active consumers use the platform every month, and being able to really drive trust is the core engine of growth of the Eventbrite transactional platform. And so I certainly think that, you know, being able to extend that trust to more and more consumers is going to be a key ingredient of Eventbrite continuing to strengthen its brand equity and also its performance for event creators. And so certainly I think what we've been able to show investors is that our market is really different from the head of the market that you see with Ticketmaster. It's a vast middle market opportunity full of event creators who are creating their own content. So it's a slightly different business and proposition, but also consumer trust is just as important.
Do you think that AI and machine learning technology will make it easier to, you know, do these sort of shady business practices, or make it harder? I mean, there has to be a better way when it comes to ticketing.
Yeah, I think that technology solutions to create fraud abatement and any other sort of bad actor will be actually an enablement for a better marketplace.
Our conversation there with Eventbrite CEO Julia Hartz. Well, Hong Kong's second biggest tech IPO of the year delivered a strong start. Meituan climbed 5.3% in its first day of trading after raising $4.2 billion in its share sale, a sign that CEO Wang Xing's increased focus on profitability is resonating with public market investors.
Our largest core business, food delivery, that's growing super fast and is also very close to break even. And on the third segment, we have new initiatives. Because we believe we are going to build the largest e-commerce platform for local services. So I think we are going to become profitable in our more mature business.
Joining me now to unpack the Chinese food delivery giant's listing, our Bloomberg Deals reporter, Alex Barinka. So how do they plan to use all this cash?
Well, right now in China, there's a big fight going on. It's Meituan, this company, versus Alibaba. They're basically the only two companies standing trying to grab this food delivery market in China, which people peg at $1.3 trillion market. So huge market here. My guess is that's all going to go back into trying to grow that business. Alibaba has been really fighting, pushing a lot of subsidies into the market, making it really cheap for customers to buy food on their platform to grab market share, and Meituan has had to really compete. So that is a very unprofitable business. It's something that investors will be watching how much they're spending on these subsidies and things like that. So that's where I think the majority of the spending will actually go after this listing.
Right. Investors are concerned about the spending, which is fairly typical for a food delivery business. And yet the IPO, the initial day, is so much better than Xiaomi, for example, another big HK-based IPO this year. What's the difference?
So this one seems to have a little bit of traction with the food delivery business and add-on services. It is consumer focused. Perhaps investors wrap their head around that a little bit more than Xiaomi, which is kind of a sprawling empire of tech gadget making. I will point out, Xiaomi listed earlier this year. If you've seen the stock movements in Xiaomi, they've kind of tracked along with general sentiment toward Asia tech stocks, which hasn't been great lately. A lot of folks feel like they got burned by maybe some overheated valuations and people have pulled back from the market. So the timing might have been on Meituan's side and getting out now, and Xiaomi may have also kind of taken a hit from that broader sentiment.
We're also seeing Chinese tech companies go public earlier in their life cycle than U.S. tech companies. What's the strategy there?
It seems like the thing that I'm hearing from all of these executives, whether they're listing in Asia or we've had a number of big listings here this past week, is they think it's a big marketing opportunity. Why not go out? The investors seem to have the appetite for it. As they're facing these big fights domestically, they're trying to kind of tap additional pools of money. So why not go earlier? In the U.S., it's been a bit different. We've seen the startups here basically want to build out a big business before taking that plunge. A few smaller companies like Eventbrite and SurveyMonkey are coming up, so they are kind of bucking that trend. But the big consumer-facing tech companies here we've seen sit on those IPO plans for almost a decade. So we'll be watching those for sure.
And yet, we're in the midst of a trade war. How is that impacting investor sentiment?
So it depends on the company. So I talked to the CEOs of NIO last week, the Tesla of China. He actually said that it's better for them because they sell domestically. If there are tariffs on Teslas, then that's a boon for their business. So if it just depends. The other point was, well, they do get components from the likes of some of the chip makers here. So there's additional costs added on to those layers. So from a company's perspective, from their actual top line and bottom line, it seems like it depends on where they're selling their products into. Meituan, perhaps not that big of an impact, but for broader market sentiment, again, we've seen the roller coaster in China tech stocks, and these trade wars with the U.S. probably don't help.
All right, our deals reporter, Alex Barinka, as always, thank you. Still ahead, things are looking up for sustainable farming. How vertical farms could solve the food crisis of the future. Next, this is Bloomberg. By 2050, the global population is expected to grow to 9.8 billion. 2/3 will live in cities. With a growing population and limited resources, sustainable food production is now needed more than ever. That's where vertical farming comes in. Indoor farms can transform industrial, arable land into crop caches, using less space, water, and pesticides. But while the technology is environmentally friendly, what does it mean for farm laborers? Bloomberg's Aki Ito investigates.
It might look like we're inside a spaceship, but this is actually a farm. The crops here are grown mostly by machines, with the help of just a few humans, like this woman. Her life offers an early peek at a new kind of farming. It's a promising twist to an ancient career, but only if the robots don't replace her altogether.
My name is Katie Morich, and I'm a vertical farmer.
Katie works for a 3-year-old startup called Bowery. Its farm is here, in this industrial park in New Jersey.
How are you?
It's the last place you'd expect to find any sign of life. Step inside and you'll see a cross between a factory and a lab. Trays of produce are vertically stacked to save space, and each of them is given just the right amount of light, water, and nutrients at the optimal temperature and humidity. It's an incredible level of precision, which is why Katie can grow more faster with less water and no pesticides.
What's this? This is the sorrel. That tastes like candy apple.
Whoa! It's so sour.
I know.
The majority of this facility is automated. The data is collected by sensors, and a computer controls growing conditions for the crops. For the things that the machines can't do yet, Katie and her fellow human farmers fill in. And even those tasks are dictated by the software that runs this whole operation.
It lets me know what I have to do, what time I should be doing it by, and that's how I get my day done.
After a full day at the farm, Katie likes to bring home samples to her husband, Jace, and her cat, Burton. On the menu are 2 items from Katie's farm: basil for pesto pasta,
That's so good.
and mixed greens for a salad.
I'm terrified. Everyone's judging. Cheers, guys.
Cheers.
Cheers.
Katie fell in love with environmental science in college, but after graduating, she struggled to find a full-time career in the field.
Jace had to deal with me a lot. You know, coming home to me crying and trying to figure out if I'm making the right decisions. And then somehow online Bowery popped up.
She told me about this job, like Bowery farming. It's like an indoor vertical farm, and I was like, all right, this sounds like total BS. So I took my work truck and I said, you know what, let me swing around and see what this is all about. So I drove up to it. Doesn't look like there's a farm in there at all.
But I figured I'd go and check it out for myself. And I pulled up and it was exactly as how he described, but I gave it a shot.
And so in 2017, Katie joined Bowery. She became employee number 9. Bowery is backed by some of Silicon Valley's top investors. And with almost $30 million of funding, the startup is expanding fast. And in May, Katie got promoted to lead a team of her own farmers. The world's population is set to reach 9.8 billion people by 2050. 2/3 will live in cities. And we're gonna need all kinds of new technology to sustainably feed everyone. The key to making that food affordable is to continue to make more with fewer farmers. But no matter how high-tech all this gets, Katie thinks there will still be a place for her.
I just think there's something about the human mind that you can't really replicate. So I think we could still work closely with technology, but I still think it's nice, you know, to have a human there. It's also be pretty lonely for the robots if they don't have anybody to talk to.
That was Bloomberg's Aki Ito at Bowery Farms. Coming up, a man who's worn many hats, campaign manager, deputy governor, and even fixer. Here with his new book with plenty of juicy details. You don't want to miss it. This is Bloomberg. Bradley Tusk is a self-proclaimed fixer. His firm, Tusk Ventures, describes itself as the first VC dedicated to helping startups navigate political problems. He was Uber's first political strategist, and I should also add that he served as Mike Bloomberg's campaign manager in 2009, the founder, of course, of Bloomberg LP, and has also served as deputy governor of Illinois. Joining us now on his new book, The Fixer, My Adventures Saving Startups from Death by Politics, is Bradley Tusk. Bradley, thank you so much for joining us. So what exactly does it mean to be a fixer?
I think it ultimately means to be able to get things done. And in my case, it's how do you work with startups who have to disrupt and then take on big entrenched interests like the taxi cartel or the hotel industry or the casino industry, who have unlimited amounts of money for campaign contributions, and overcome all of their political power so that you have the opportunity to compete. So for me, that's what it means. I think other people might see it differently.
So is this about skirting the law, exploiting it, playing nice?
Maybe a little bit of all. The book kind of goes through in detail. When should you beg for forgiveness? When should you ask for permission? But ultimately, in almost every case, any startup that we're investing in has come up with some new way to do something that the law just doesn't address one way or the other, because if the lawmakers could have thought of that stuff, they'd be entrepreneurs and not bureaucrats. And then it's a question of how should it be interpreted, and then there's always a food fight between the people who are already in the business and don't want to lose market share and the startups who are trying to get a foothold. And then ultimately we have to kind of beat up the entrenched interests and then convince the politicians and regulators that either the law is okay or we have to change the law to make it okay.
So what kind of advice did you give Uber in those early days as they were running up against New York taxi regulators and other walls?
Yeah, I mean, the real thing for us was to mobilize our customers, right? Taxi is an incredibly powerful lobby. Like here in New York, Bill de Blasio, he's the mayor's biggest campaign donor. They have a ton of lobbyists on the payroll. So the only way we couldn't compete with them dollar for dollar. So instead we said, okay, we have millions of customers around the country who really like ride sharing, who don't want to lose the opportunity to do it. So let's mobilize those people and have them tweeting at their council members, emailing them, calling them, and just create so much overwhelming force that even though normally the politicians would just want to do the bidding of their donors, they can't get away with doing it here.
That said, some would say things haven't worked out quite so well for Uber when it comes to regulators. There are multiple investigations open, federal investigations, criminal investigations. What went wrong?
You know, the gray ball stuff I read about in the Times, like most people, so I don't have any real particular insight into that. But I will say, when you ask the question, was Uber too rough? Were they too aggressive? I think the answer is no, simply because if Uber wasn't that way, we wouldn't be talking about them. They wouldn't exist right now. I mean, the only way for them to come into existence was to break the taxi cartel, and that required playing hardball. In fact, one of the reasons that Uber just lost a fight in the New York City Council, I think, is because, you know, Dara, as a CEO, is really good at being conciliatory and avoiding confrontation. I think that's what the board wants him to do. But you can't be the person that everyone likes and the person kind of throwing punches in the city council at the same time. And Taxi saw a vulnerability there and they exploited it.
A lot of big tech companies right now are at odds with the government. Google, Facebook, Twitter. You know, where did they go wrong, and how would you advise them now?
You know, what's interesting about those companies specifically is they actually came up in a more frictionless environment where they weren't disrupting an existing entrenched interest in the way that, say, Airbnb is disrupting hotels or FanDuel is disrupting casinos. There was no one doing what they were doing, so they didn't really have to have the same kind of fighting on the front end. But I think as a result, they were lulled into this false sense of security that, you know, they could just say, don't be evil, and everybody would love them and everything would be fine. And the reality is, politics always comes for you, right? Eventually you get big enough, you get strong enough, you piss enough people off, and they're going to want to get their pound of flesh. And that happens everywhere. And I think where Google, Facebook, Twitter probably have made a mistake is they just didn't anticipate it enough, they didn't prepare for it enough, and now they're scrambling.
You implemented the first mobile voting pilot in a U.S. election. Now that we have less than 50 days to go, I mean, this idea that more tech is better, can also mean more tech means more vulnerabilities, more opportunities to hack. Are you concerned about the security of our upcoming elections?
Well, the pilot that we're working on is specifically blockchain voting, and the reason it is blockchain is because, at least right now, blockchain is totally unhackable. I think the current system we have is extremely vulnerable, and that's why we're working on this new idea, because we want to both radically increase participation by allowing people to vote in elections on their phones, but also making it a lot safer than it is right now. But no, do I think the 2018 elections are secure? Not really.
Now, President Trump, even though he doesn't really use email, he said, has certainly used tech to his advantage, of course, with his use of Twitter. How would you advise a candidate trying to take Trump on?
I think that ultimately you've got to be able to show that you're able to fight with this guy toe-to-toe. I think all the other strategies of appeasement or ignoring him or whatever else don't really work. And that's why I think, you're going to see a lot of people from the left emerging in 2020 to challenge him, because they really want to battle. People are feeling very partisan. People are feeling really polarized, and it's going to be ugly.
All right, Bradley Tusk, CEO of Tusk Ventures, out with a new book, The Fixer. Bradley, thanks so much for stopping by.
Thanks for having me.
And that does it for this edition of Bloomberg Technology. I'm Emily Chang. This is Bloomberg.